Good evening, Asia. Good afternoon, Europe. And good morning, America. My name's Ambrose Conroy. I'm the founder and CEO at Seraph Consulting. Thank you for joining us for the September 2024 webinar. Lots to talk about. We enjoy all of those who have joined us in the past being back. We're looking forward to having discussions with new people. I've got Wade Phillips here joining me. He's president of Seraph Europe.
Thanks, Ambrose, and thanks for everybody joining. We appreciate you joining and taking your time to listen to what we have to say about the industry. Like Ambrose said, we're going to talk a lot about things that have changed and some of the things that are the same over the past quarter or so. And if you're joining, you're automatically signed up to receive the report that we're about to present. But while we're presenting, you may come up with questions that you want to ask. And please add those to the LinkedIn chat, and we'll get those answered at the end of the presentation.
And if you've got a larger organization and you're interested in having a conversation with us and your organization, please let us know. We're always happy to come in or do a virtual meeting with your team to help share our views and answer your questions specifically. And on that note, let's jump into the webinar. We're going to try to start off with the four themes that we're seeing. There's a China impact theme. There's OEM and supplier commercial relationships. We're all very familiar with those. We live with that pain. Profitability, debt financing is a real challenge right now. The challenge, though, isn't so much the financing, it's the refinancing, it's the time it's taking, it's the cost. EV adoption and government infrastructure failures, we're seeing a real challenge there from an excess capacity. We're going to talk a bit about that. But in 2019, we thought we had an excess capacity. We've more than doubled that capacity globally for cars in general. So we have to do something to take cost out. We've got a lot of different powertrain struggles right now. It's causing releases from OEMs to go all over the place, which is driving the supply base wild. And then we've got some market dynamics. We've still got vehicles that are too old. The average age of a vehicle is increasing, but consumers still see them as reliable and they're not racing to replace their vehicles. So one of the questions that I ask always is, are we building vehicles that are too good? If we've got this excess capacity, if we planned on an 8-year replacement cycle and we're seeing vehicles last 13 years, what are we doing wrong? Are we capitalized for the right infrastructure? Are we doing things the right way? And allowing for strategic future competition. We think there's a lot more regionalization that's going to happen. We're going to see people really focusing on OEE, how to make what they're doing in a better, more efficient way. And we're going to see people look at how do they take cost out. And that's going to be some hard discussions, because to take cost out, you have to take roofs out. You have to do some things to get your manufacturing network to be the right way. But I think the real area that I want to focus on that we're going to talk a lot about today is the China impact. There are a couple of things here that today it's really timely to talk about these. Yesterday, the Biden administration put out some new rulings looking at things coming out of China, cars and car parts coming out of China, software coming out of China. By 2030 model year, we're not going to be able to have vehicles made in China shipped into the US. So we're no longer talking about tariffs, we're talking about a prohibition. That's a hard one, and that's from the Biden administration, not the Trump administration. We're seeing tariffs increasing. Tariff increase is coming into effect. It's a 100% tariff increase on vehicles from China. And then geopolitical conflict. We're seeing China be more directly involved in the conflicts in Ukraine and with Iran and with others. There are Chinese components making their way into different things around the world. That is giving people pause. We're likely going to see not just governments looking at what can they do. It's not going to be just, should governments stop? Should we put up walls? Should we block China from coming in? Should we boycott Chinese goods? It's going to be consumers looking at, do we want to buy these Chinese goods because they're doing something that we don't support? There's a lot of room here that hasn't been thought through, that hasn't been part of what we've talked about in the past, that we're going to get into and we're going to go into in depth.
And it'll be really interesting to keep an eye on our leader surveys that we do each one of these webinars, because I think it was in the last one or maybe the one before that we asked leaders in the industry what kind of investment they were making in China, given that there was a strong decoupling that we were talking about at the time, which we really haven't seen too much or as starkly as we would have expected. But there were a number of both suppliers and OEMs that says we're going to continue to invest in China. We're not making any changes at all. Now with all of these tariffs and those kind of things, we think that's a huge mistake, by the way, because going forward with some of these geopolitical conflicts and the tariff landscape that's changing, that's going to be a substantial problem going forward.
And I hope people's investment cases only go out to 2029. If you're making anything that's electronic, anything with camera,
Right,
anything with
right.
LiDAR, anything that has software in it, and that's being done in China, you're not going to be able to bring it into the United States. So that's a real challenge.
Let's get into it. So every one of these webinars, we do a leader survey of leaders in the industry, both at OEMs and suppliers. And I don't think it's any surprise to anybody paying attention that the declining sales and volume reductions for both OEMs and suppliers, as well as cost and financial management, are the significant issues. Supply chain and logistics, we would always expect to be at least mid in that list. But certainly a difference here is during the pandemic, we saw skills gaps and employee retention being the most significant issue, followed by supply chain and logistics. But we're seeing a little bit of a reorder now, and with the Chinese and the increase in global capacity and the significant number of nameplates and OEMs entering the market, we're starting to see declining sales and volume reductions and cost and financial management be the significant issues.
I find it interesting that a few years ago we were seeing OEMs looking to slim down their product offerings to really focus, to be very clear what their brand was, what the brands were delivering, and they did a great job of that. We're seeing a little bit of inflation there, but there are so many new brands emerging. There's so much more competition coming out. I didn't think it was possible. If you had told me in 2010 that we were going to see new automotive brands emerge, I would have told you were crazy. It was almost impossible to enter, and now everywhere they're coming out. And I think they're coming out supported by EVs, because you don't need to build that powertrain infrastructure, because powertrain had always been the big differentiator, and it's not anymore. One of the things that I think is driving this decline in sales volume is there's not a feeling within consumers that they have to rush and get the next best thing, because what they have works really darn well, and they don't have the money to do it.
Right. I agree. And this data is looking forward versus just Q2. And interestingly enough, it's not much different. So the problems that OEMs and suppliers are seeing today, they expect that they're going to see the same problems going forward in the next quarters.
But what I always see, there's not an OEM that I know that won't tell a supplier that things cost too much, prices are too high, or that there's something wrong from a sales. Sales will always complain. But that's a key thing here for pricing and costs for the OEMs. And they're making great profits right now versus the suppliers, where it's volume, sales, and market demand. So suppliers are seeing that fluctuation, those releases changing more radically, and they expect that to continue. That really doesn't bode well for the industry, and it's something we need to figure out how to lock down. So sales volumes have continued to be sluggish across the U.S. and Europe. What we're seeing is the volumes are down. They're down to a point in the U.S., but they've reached a new steady state. We're down 9% from pre-pandemic levels, but that's okay. We're there, and I think we've talked a bit about that already. We know that there's pent-up demand. We know that people are delaying purchases. We're seeing replacements happen. People are buying vehicles. The real shock for me is Europe, and the August number blew me away. So an 18.4% year-over-year drop in August registrations. Something's happened in Europe, and that's really terrifying. I think some of it may have to do with tax credits that have gone away. We're hearing a lot about charging infrastructure, even in Europe, not being adequate. There was just an article I read in the UK where if you can't charge at home, you're paying double the price for fuel by charging with electricity at public charging stations. So there's a lot of fear in consumers' minds, but none of that really explains that 19% drop. That's a scary drop in an economy that seems to be reasonably healthy.
Yeah, both charts look very similar up until this point, relative, but certainly similar. There's some pent-up demand because of the pandemic. We're less than we were in the pandemic, but increasing, maybe a little flat. But this projection in Europe, and basically all we can find so far is just incentives going away. But I think Europeans are starting to question the viability of continuing to go 100% electric.
And I think the big challenge here is that the U.S. is build to stock. So the OEMs build cars to inventory, but Europe builds them to order. So there is a direct impact here. A 19% dip or an 18.4% dip, if that follows through for the quarter, we're going to see a massive decrease in orders going into the factories, and we're going to see a direct impact across the supply base right away. There's not that cushion. There's not that buffer.
So we talked about U.S. OEMs built to a stock, and what we're seeing is you see the huge dip in inventories during the pandemic, and we're starting to grow that up a little bit. It's starting to stabilize, less than maybe before the pandemic, but certainly stabilize. But the transaction price you can see is a 28% increase pre-pandemic to now. Now it's to come down a couple of percent since its peak in 2023 and January of 2024, but certainly a 28% increase in vehicle transaction price is significant in the U.S.
That's really high. And with interest rates going up as well, it's no wonder that consumers are holding off on purchasing.
Yeah, and back at that time when the transactional price was 36,000 or so, or 37,000, interest rates were 2% or a little over, and now we're talking, I think we're down to 6% now, something like that.
And it's the big three that are really driving a lot of the inventory numbers right now. They're back to their old ways of holding inventory and just building because they have to keep the workforce going. It's harder to furlough. It's harder to manage the build. So they have to find a way to sell, and that's something we're going to have to watch. The inventory numbers are getting to a point where they're flashing red, and we need to understand how these vehicles are going to be moved, what's going to happen with financing, what deals are coming. And maybe consumers are pausing, maybe consumers are waiting, maybe we're going to see that change.
Yeah, the national average is 77 days of inventory. Pre-pandemic, we were targeting about 60 days. And it's interesting that the foreign, if you want to call them that, foreign automakers in the U.S. are that and below for the most part. And the Ford, GM, Chryslers, some of them are twice the national average.
Not a good sign. I think that's going to have a big impact on EBITDA. I think in North America right now, we're seeing EBITDA margins converging for suppliers and OEMs at a reasonable level. But if we continue to see inventory builds, I expect we're going to see a hit to those EBITDA numbers for the OEMs. They're going to have to do some things with incentives. They're going to have to get consumers to come out and buy these vehicles. In Europe, we also see EBITDA margins converging. They're getting closer. They've recovered from where they were at the start of the year. But we're at a point where there's still a lot of tension and a lot of concerns around how are the suppliers going to cover their debt and refinance their debt moving forward. So EBITDA margins are getting better. That will give them some power, but they're not at a point where they've rebuilt their financial safety net.
Yeah, from a European perspective, it's good to see that it's starting to converge a little bit. But like I mentioned, the executive from the large European OEM, he hears about that gap between that gold line and the black line. He hears about that every day from his suppliers. So we've talked about the EV market adoption, and we've talked about the tax incentives going away. We've talked about infrastructure. We've talked about those kind of things. But we've also got to look at the targets. So in each of those years, down at the bottom there, 2020 through 24, we expected to be at a certain point in 2025. But as we've gotten closer to that 2025, we've reduced those targets substantially and pushed them out to 2030, as you can see it climbing 2020 through 2023. But now we're starting to see that back off in 2024. So what that means is that the closer we got to 2025, we kind of said, yeah, just kidding, we got to push that out to 2030. But as we start to approach 2030 now, we're starting to do the same thing.
And as a Californian, this is very interesting to me. So we're saying that we're not going to hit those targets, and I think this is an area where both Brussels and Washington have really failed. They had programs in place, they were driving this, but they've failed to deliver. They failed to get the infrastructure in place, and they failed to get enough incentives to get consumers to take a chance and buy into the EV transition. The industry as a whole made a massive investment. We bet the business on this EV transition with the backing of Brussels and Washington. And Brussels and Washington have failed to step up. The only government in the world that's really supported this in a significant way has been China, who's built out the EV infrastructure and who's gone all in on electric vehicles. And they seem to be doing well, and they've got a thriving industry, but the rest of the world is struggling.
And that's evidenced by most of you can see the list here where OEMs are starting to pull their investment back. So this list, I won't read them in detail, but suffice it to say that each one of these in either the U.S., Mexico, or Germany, they're delaying their investment to transition to EV even further.
And none of this is surprising. We've talked about this already. Governments are taking away the incentive programs that they had to encourage consumers to try EVs. And there are now threats of regulation in Europe and in Germany. There is a risk that if you have conflict minerals in your vehicle and you're caught with that, that 1% of sales could be a penalty applied to you. So there's a lot of risk and there's a lot of pressure here that doesn't support continuing to double down on this investment without the governments really stepping up and getting behind them.
So as we mentioned before, that every time we put out one of these reports, we do a survey of leaders across the board. And we've asked them, how do you expect the effectiveness of each one of these in improving profitability? And interestingly enough, we deal in OEE a lot with operations efficiency and that kind of thing. Most of the respondents suggested that that's where they're going to put their focus, which we applaud. I think in our last webinar, we mentioned about how through the pandemic, we seem to have lost a lot of efficiency and traded that for going to the suppliers, going to the OEMs and asking for recovery for inflation and some of those things, which is real. But at the same time, there's opportunities to offset that because we lost our way a little bit with regard to efficiency. Based on the respondents to our survey, the leaders are starting to refocus on getting their efficiency where it belongs.
And we're seeing OEMs. There's one particular OEM that we know that is having a significant warranty issue, and they had a warranty issue because it became about getting vehicles out to sell, and they're paying the price for that now. We all know that you can't just build parts to ship. You have to build quality parts to ship. And I think we're finally getting back to a normal cycle.
Now, from a commercial perspective, we just talked about the operational activities. Now, the commercial activities, they're starting to look at other things besides recovery from the OEMs and those kind of things. So we're seeing supply chain restructuring and plant consolidations and relocations. We're going to talk a little bit more about that in a little bit in the presentation. Ambrose has mentioned a couple of times the doubling of capacity, or even more than doubling of capacity, given the China capacity they've installed. And the industry is going to be ripe for consolidations and relocations of some operations.
The only way to really take cost out is to eliminate the cost, and that means shutting down plants that aren't fully utilized, increasing your OEE within the plants that you have, making your plants more productive and more efficient, and getting things closer to your end customer to reduce your logistic costs. We need to figure out how do we run a much better manufacturing network, getting rid of those historical legacy operations which were there and are a drag. We've got to figure out how to take those restructuring costs and move on. Sometimes
we always look at the kind of the top. It's just as important to look at some of the bottom. So we're not looking at outsourcing as heavily and M&A activity, which is interesting when we start talking about plant consolidations, relocations, and that kind of thing. You'd think that M&A activity would go along with that.
M&A activity is starting to heat up. I think M&A was really constrained because of the cost of capital. Mm-hmm. But as the cost of capital rationalizes, I think is rationalizing. We saw that 50 basis point cut. I think we're going to see more M&A activity building. It's starting. We're hearing that from the bankers, but we're not seeing it yet.
Right.
Talent has been something we've talked about on these webinars constantly, and it was we couldn't get blue-collar workers, we couldn't get white-collar workers. We're continually seeing, every time we talk about this here, skilled trades and maintenance people. They're just not out there. They're not available. People haven't wanted to put in apprenticeship programs. They haven't really done a good job training people in the past. HR is still, and this is one of my real problems across all industries right now, HR is still very much risk management and cost containment, and we need to become human capital development people. When HR shifts to develop human capital, and we start growing our own skilled maintenance and trades, and when we start developing the next generation, we're going to be much better off.
And that skilled trades and maintenance, specifically maintenance, has a direct correlation with the OEE.
Absolutely does. And the skilled trade side, I think what we're seeing, China has a lot of skilled trades and maintenance people. They've not been afraid to invest. They've not been afraid to develop them. So that's part of what is driving their ability to ramp up their manufacturing and be highly competitive. I guess we look at manufacturing shifts. This is something that's really interesting to me. And we've put together some unique research here. We were asking ourselves some questions. Ray Dalio has been talking about this. Others have been really focused on the rise of China, the fall of the West, what's going on. And what we're seeing now is we're seeing a massive surge in China since 2000. China has hockey sticked up. It's like a dot-com stock for those of you that are old enough to remember those. They're on this stellar climb. The U.S. has fallen since the post-World War II boom. We're falling off. Germany is holding steady, if down a little bit. Japan has fallen massively. The real standout in the post-industrial revolution world now is China. As we move forward, China is the manufacturing heart of the world. And they were there before, pre-industrial revolution. China was the place that did manufacturing. China is again the place that does manufacturing. For a country, for a people that take a millennium view, it's much easier for them to deal with a change in technology that took them out of the driver's seat. They figured it out. We, as the West, made massive investments in China. We transferred incredible technology there. We taught them how to run plants. We trained them to be incredibly efficient. We developed the people. And we have created this manufacturing engine in China that continues to thrive and improve. It's almost like the AI that everyone fears is going to become self-teaching and self-improving. It's not AI, this is people, and the people in China have done a phenomenal job becoming the manufacturing engine for the world.
I think that's probably, if it's frustrating, that's probably the most frustrating part about it. It's almost like we equipped them to compete with us, and now we're having to compete. We gave them the technology, we gave them the investment, and now it's self-sustaining in China. And if we don't do something significantly different, they're going to continue to be the manufacturing powerhouse in the world.
We did it because we wanted cheaper goods. We wanted goods to be very low cost, and we wanted to live a better life, and we got a generation or two with that, but it's definitely impacting us now. What we're seeing here, U.S. manufacturing is growing, so it's not all doom and gloom, but we're not growing as fast as China is. And we need to figure that out. We have to move forward more aggressively. We have to figure out how to manufacture more in the USA. We had the whole Made in the USA initiative when Japan started coming onto the market. But we need to get back to Made in the USA. Maybe it's not even Made in the USA anymore. The North American region, Mexico, the US, and Canada. It all comes together, and we've got a great pool of labor. We've got a manufacturing base. We've got minerals. We've got resources. China has minerals. They've gone to Africa. They've pulled things in. Their Belt and Road has enabled them to go out, and anything they didn't have in the country, they've pulled it in. They're even finding low-cost labor in other parts of the world that they can pull in to do things. And we need to figure out how do we support our own domestic markets with our domestic brands, because that's what China's doing. China is now buying China for China. The Chinese consumer used to think that Chinese brands were not very good, but now they're seeing Chinese brands as world leading. People want to have a NIO. They want to have a BYD. They love the Xpeng cars. They want those vehicles. And we're seeing a fall off in revenue in China for all of the OEMs. And it's been a very rapid fall off. And if that trend continues, there's going to be almost nothing left there for the West to capitalize upon. We'll have to see what happens with the economic struggles that they're having. There is a debt crisis. There's a real estate crisis. There are a lot of drags on China, but even if China is growing at half the rate they normally grow at, they're still growing faster than us.
So let's talk a little bit about tariffs. The U.S. obviously has taken a much harder line on a trade war, really, with China, and that's coming from the Biden administration. And there's a lot of information on this slide, but just kind of summarize it. The U.S. has taken a really hard line. The Biden administration has taken a really hard line. And former President Trump, if he wins in November, it could be even more substantial.
I wouldn't say could be. I would say would be. I think the 10% tariff is a minimum, and we could see 60, 100% tariff put in on
all Chinese goods,
on all Chinese goods,
right,
on everything that comes out of China, and you won't be able to use a secondary country to do a little bit of value add and move it in. It'll be a hard tariff. That is the risk there.
Yeah, that's a fair point. I trying to give a benefit of the doubt that maybe it won't, but I mean he's been pretty clear. He's telegraphed his moves, right?
I think if people think that if there is a potential, and I think it's 50-50 right now, businesses have to contingency plan. We have to have a plan for what happens if everything that we buy or has Chinese-made components in it buy from China or has Chinese made components in it goes up, doubles in price, then what do we do?
Yeah.
Is it still economically viable to do that, or how do we re-engineer our supply chain to regionalize or localize and make the products elsewhere?
Europe's been a little bit slower on the uptake. They're still deliberating. There's going to be a vote in EU in October, but they are increasing their tariffs, but we could see an increase even beyond that, but certainly not as dramatic as what we see in the U.S.
We're not seeing the pushback from the European OEMs as vocally as we are from the American OEMs. Jim Farley has basically called the threat of China an existential crisis, and Elon Musk has come out and said that we have to do something about it. They're going to just take over the industry if we don't stop them.
Right. Now, it's interesting, if you drive the roads of the United States, you don't see a lot of Chinese vehicles, if any. But certainly in Europe, you're seeing a lot more of them. So you can see the upswing there on the left-hand chart. EU imports from China from 2020, it's increasing substantially. Still a low number at this point as a percent, but the slope of the curve is the scary part. Automotive components is starting to back off a little bit, but okay. And then on the right, you start to see, at least as of 2023, that matching slope by OEM. And I will tell you, in 2024, I fully expect that to be even higher and increase at an increasing rate. If you look at this BYD, it's a little red bar there in 2023, but I'm seeing in Europe a lot of BYDs. So I'm fully expecting that little red bar of BYD is going to grow substantially, and so will the rest of them.
BYD is a really interesting one because that's the one that Berkshire Hathaway got behind. Warren Buffett, who's not a technology investor, singled out BYD, and they made an oversized investment there. They knew they were going to be transformative, and they really got behind them. So we'll expect a lot more from them, and them to be more of a threat. Part of the reason I think that Buffett made that investment, part of the reason he's articulated he made that investment, was because of the incredible vertical integration that BYD has. They're all the way from the battery manufacturing up through building the final car. They make the parts themselves. They really understand what it takes and what's required to make a car cost effectively, and they don't have the supply chain margin built in. They're able to make these cars, and they're able to drive cost out, quality in every step of the way. So let's look at the imports into the U.S. And we expected everyone to be really driving nearshoring and regionalization. We expected to see massive movement coming in. We were looking for a lot, but there's some things that are preventing it right now. We've got a challenge in Mexico right now. And Mexico is the region's low-cost country. People. You can't bus people for 2 hours and expect them to stay working. We're seeing that in the Monterrey area. We're seeing it in Guadalajara. We're seeing it in Querétaro. There is an absence of blue-collar labor. We're seeing an absence of maintenance people. Skilled trades are missing. There is just a huge problem right now within all industry in Mexico. And automotive, because they're paying lower rates, are really suffering.
Not to mention the infrastructure issues, right? They're struggling from just an electrical grid perspective.
Yeah, we're hearing that again and again. And we've got one particular plant that we're working with right now where they're not able to come online because there's not enough power in the park. And we look at that closely when we're doing our plant relocation work, when we're doing a move project. We want to make sure that there's enough power available for that building. It can't be 18 months in the future. It has to be now. We also think that we're going to see this whole reshoring, nearshoring, best shoring wave accelerate. There's a new wave of tariffs that are coming out to prevent the Chinese from expanding even more. We're seeing it in auto parts. If Trump gets in, we'll see more. But the Biden administration yesterday put out a ruling that by 2030, and some of this rolls in sooner, some of it takes out till 2030, model year vehicles, auto parts that have any sort of electronic component in them that can connect to Wi-Fi, cellular, or transmit vehicle to vehicle will be banned from coming in the United States. That's massive. We're still figuring out exactly what that means. The text isn't exactly clear, but that was really big. There's also a ban So forget about the tariff in 2023. There is a ban on vehicles made in China. So if you want to sell a vehicle in the United States in 2030, it won't be able to have either Chinese-made components that are electronic or be made in China. And then there's a third aspect, which is software. You won't be able to have software in the vehicle. So you can't do any automotive software work in China. That becomes really difficult for OEMs that have a Chinese counterparty, that have a joint venture partner, or have some operations in China and want to develop a global platform. There are other commodities where we're seeing pressure already. Aluminum and steel are areas where things have happened and we've pushed back. And then we've got the chicken tax, which really built up the SUV industry in the United States. That 25% tariff on trucks and SUVs coming into the US has been very protectionist and has worked very, very well. So we expect to see the automotive vehicle tariff of 100% that's coming in be even more impactful, preventing Chinese cars from coming in. The question is, what will happen when China sets up plants in Mexico? Will they be able to take advantage of USMC rates, or what's going to happen there? How are we going to see the tariffs moderate, or is it a pure Chinese brand is not going to be able to sell in the United States without the tariff? And what will happen in Europe? Will the same thing happen there?
So, Ambrose, you mentioned that we expected to see a lot of reshoring and relocations, but it really hasn't materialized yet for various reasons. So at Seraph, we said, okay, so it's still out there, and given the new tariff kind of landscape, we're gonna have to start seeing some exodus from China, whether it's reshoring or not. And so we've done some predictions, and we're going to see things move to some other more friendly countries: Japan, South Korea, Southeast Asia. Obviously, we've seen a lot moving to Mexico, some in South America, and then some of it we're going to bring back to the U.S. or Europe, right?
And you've got Africa right now. Africa, we're seeing tremendous raw materials shipped to China. We're about to start to see some of that start to ship to the U.S. Mm-hmm. So we've got to take that into account and really understand how that could play. But we're going to see a lot of manufacturing that has historically been done because of low labor costs in China move out. It needed to move anyway. Logistics costs have increased to a point where it's not necessarily tenable. Labor costs have increased to a point where China isn't the lowest cost country to manufacture in anymore. So the natural pivot is to move away. But their quality has been good, and it's a reliable manufacturing environment. So they have continued to build the infrastructure and develop the manufacturing that's needed. We will, I believe, though, as you're saying, Wade, see that big shift out, and it'll go to other places within Asia, and then it will come to the regions. But questions exist around, can Mexico handle it? Are the low-cost countries in Europe able to handle what needs to come out? Where will this actually go?
Yeah. In our survey, we've asked, okay, so with this tariff landscape and it's changing and increasing and that kind of thing, how many leaders think that's going to affect their business? And it's most, 73%. So most know that the tariffs are going to impact their business, but the respondents told us that really only about 23% of them have really vetted that out and said, here's what we're going to do about that. So, they know it's going to impact them, but they don't really know what they're going to do yet.
And not having a plan is having a plan.
Right.
Hope is not a strategy, as we all know. If you don't have a plan to do anything, you're just going to take that cost and your bottom line is going to get hit. And the OEMs aren't going to have much mercy on suppliers that didn't have a plan, that have a contract in place, and all of a sudden get hit with a much higher tariff. It's going to become a very ugly market again, even uglier for those suppliers that don't have a plan.
I think the message on this slide is really as those relocations start to happen, we really need to take a look at the overall landed cost, right? So in a lot of cases, some folks went to China because of the labor costs and really negated the fact that it was going to cost more than the labor save in logistics to get it back, those kinds of things. And suffice it to say on this slide, some of the respondents have rank ordered access to labor as a significant high importance, whereas utility costs are something that isn't as concerning to them as they make those moves. But ultimately, it's a combination of all of these attributes, including risk. So interestingly enough, the pandemic and the supply chain risks that we ran into And not just with the pandemic. We had a lot of black swan events there for a while, Texas storms and all kinds of other things. But proximity to suppliers is low on this list, which is surprising because the wounds from the supply chain risks of the pandemic and some of those black swan events are still fresh. But that seems to be what the respondents say. So ultimately, that was a little bit of surprise, but ultimately it's a combination of all these things that have to be taken into account when trying to figure out what that supply chain should look like.
And I had some conversations around that way, proximity to suppliers, that people were in some cases planning on keeping more inventory, but they don't want to pay for it themselves, so they want consigned inventory. Or they just want their suppliers to be more reliable. We know in automotive, we all expect our supply base to deliver 2 releases at the quality and quantity we expect. But that hasn't happened for years, and we're fooling ourselves to think that that's going to return overnight.
So before we move into the question and answer, we'll just kind of summarize here. So we've talked a lot about the China impact. We've talked about technical risks, the tariffs, and geopolitical conflict. So with the Middle East conflict heating up,
and Ukraine continuing to drag on, and China having some direct support there, it's very concerning.
Yeah, so sides are being aligned, and that's going to affect the market, I'm sure. EV adoption, we've talked about infrastructure failures on the government's part. We've talked about the higher costs of an EV vehicle. We've talked about China having lower cost vehicles or lower priced vehicles entering the market in substantial volumes. And we've talked about the tax incentives that have started to wane recently. From an OEM and supplier commercial relationship, we've talked about the supply chain impacts, relocation and consolidation, the significant debt financing costs that a lot of suppliers are having to deal with. We showed a lot of data on our last webinar about the real challenges from a profitability gap, but then also from a debt financing and investment grades that a lot of the suppliers have, and that it painted a pretty bleak picture. And then the last thing we've also talked about aligning strategy for the future, local for local. We've talked about OEE as a significant cost lever, and that seems to be echoed by the respondents to our survey. So we've talked about all those things, and I think we can at this point kind of move into questions and answers. Yeah.
Yeah, I think we can. I think we've also talked about how if we want to really change the cost structure moving forward, we have to take cost out. You have to do that the hard way, which is something that a lot of companies don't. It was a great conversation, Wade. I always love looking at the data that we've pulled together and just seeing the data that's out there, talking to everyone that we have the privilege of talking to on these things. It's great. We're joined by John Stoner, and we're going to bring the cameras up now. John Stoner is the president of our U.S. operations, North American operations. He just joined Seraph recently. It's a pleasure to have you joining us, John.
Thanks very much, Ambrose. Wade, it's good to be with you both today. And goes without saying, I'm thrilled to be joining the Seraph team. You know, listening to your conversation just now reminded me of a curse. It's reputed to be of ancient Chinese origin, interestingly enough. And it goes like this. It goes, may you live in interesting times. And it's not actually ancient, and it's not Chinese. It supposedly comes from Great Britain and just before World War II. At any rate, it certainly sums up the automotive sector right now. And I think you two have laid out the issues quite clearly. We are living in interesting times.
We are, and unfortunately, it's not just in the automotive sector, but that's a discussion for another time. Everybody that knows me knows I'm happy to have that discussion. Let's get some questions coming in here. What do we have, Justin?
Yeah, so I think one of the good questions is from Marco Arienta, which is talking about the latest news regarding China. How do you see the future of companies like GM and Ford in the Chinese market, considering both the local market downturn for American brands and the limited export opportunities to the U.S.? Is there a long-term future for the joint ventures like SAIC, GM, and Changan Ford?
So, Marco, I'm going to make a statement here that I don't think anybody's going to like. If the initial indication from the administration holds, starting with model year 2030, there is no longer a future for Western brands to make vehicles in China for the Western market. I believe Europe is going to follow a similar path to the US, and we'll see a ban on software and hardware that can connect coming out of China. So what does that leave us with? And what have we seen? We've seen a significant fall off in revenue across every Western brand in China. GM losing almost $2 billion in profit is a surprise. Mercedes is down. It's the mass market and it's the luxury market. It's the brands that everybody had to have. They're now shifting to Chinese brands. There's tremendous propaganda. There's tremendous push by the government for China's sake. So they want the Chinese local brands to go. And I don't believe that as we move through, we're going to see made in China vehicles be sold outside. Interesting thing that we're seeing right now, though, and that I'm hearing, and I have to vet this. I was just reading it this morning. GM, with the joint venture, is making vehicles for Mexico in China and shipping them to Mexico. Mexico, you've probably been down there, Marco. I've been down there. You see tremendous number of Chinese vehicles coming in. There's talk of some Chinese OEM assembly plants getting put in. They're doing some investigations. We work with a couple of commercial real estate firms, and we keep hearing about the Chinese looking to set up shop and to really establish supplier parks. And what's different about the Chinese when they do it is they very much want to set up captive supplier parks with their assembly plant, and they want to bring people in from China to really run it. And then they'll train some locals to eventually take it over. But it will always be Chinese run. It will always be Chinese driven. And that's where we're going to have to wait and see what happens with tariffs. Does that qualify to take us out of the restrictions that have just been put in place, or will those restrictions hold? And will they effectively be a hard barrier to Chinese goods coming into the United States? And then the follow-on is, what will that do to U.S.-China relations? This is a really significant move. Autos are a massive export. It's high dollar value. It's the second biggest purchase people make outside of their homes. So if you can't make these in China and sell them in the U.S., or you can't make components that go into cars and sell them into the U.S. market, what does that mean for the auto industry in China? And is it sustainable in and of itself? I venture to say it is sustainable in and of itself to support the Chinese market and Asia, but I'm not quite sure if it's going to enable them to clear the hurdles and come back and sell in the North American market in the near future. Eventually, I believe we'll see Chinese brands competing here with plants in the U.S. to get around all the tariffs, but it's going to take a little while. Justin, what else do we have?
Staying on that theme, I think we can talk about, are tariffs the right solution? From my perspective, they seem like merely a temporary contingency measure. What happens after that?
I think you answered a little bit of that just now, because I think eventually we're going to see, much like the Japanese did in the 80s, I guess, the Koreans did in the 90s. I think we're going to see Chinese plants in the United States and in the Western world. We're doing some work in Europe with a major Chinese OEM that is evaluating moving production from, right now they're building in China and shipping to Europe, and they want to build that plant in Europe so that they can service the local for local kind of thing, like we've talked about. They push the pause button on that decision for a little bit because volumes are down so substantially in Europe. But certainly as they start to grow, that's where they're going to head.
And I think then, Wade, we're going to see a trade-off between, or a tension rather, between the level of tariff and the national security implications of having a Chinese plant, for instance, in the United States. So the government intervention, so to speak, there's going to be a tension there, and playing that out will take some time.
Right. So saying, is it a short-term solution? Yeah, probably. I don't know what you want to call short-term, a year or two or five. But ultimately, it's some of those non-tariff actions that the U.S. government started to take, and I'm sure that the European governments will start to model a little bit of that. Maybe they'll follow on, but not necessarily at the as extreme as the U.S. government's being, maybe, but much like the tariffs. But I do think that the tariffs aren't a long-term. That's not the total fix. I think it is the short-term solution. That short-term, maybe 5 or 10 years, but still, it's not the permanent solution. I agree.
And I think we'll do maybe one final one on tariffs. You might have exhausted your opinions, but tariffs are a sign that the U.S. and EU cannot build competitive cars versus China. doesn't that impact market share and customer position? So I guess, do you have any thoughts about the competitive nature?
That is absolutely true. The fact is, 60% of the vehicles in the market in the world market right now are being made in China, and the fact is that they can make them cheaper than the rest of the world.
But let's step back and look at how they can make them cheaper than the rest of the world. We have transferred technology to China. We have trained the Chinese how to do it. And the Chinese are incredible at manufacturing. They've taken everything that we've given them and shown them. They've learned from it, and they have done it better than we can do it. And they don't have the legacy costs. They don't have the challenges. They don't have all of the plants which were in the wrong place. They don't have the crazy logistics systems. They don't have this is probably a bad thing to say, they don't have the union contracts, and they're not fighting the union. They don't have the legacy union costs that they have to pay. It's very much a state subsidized system, and it's going to be hard for the West to compete with that in the near term. So tariffs, and we have a good example for a long-term tariff in the chicken tax, can help to change and alter the market. So this is a barrier that we've put up to enable our companies to be competitive long-term, and hopefully we can move forward.
Well, and they're even down to the raw material level. They're locking up the raw material opportunities throughout you have a lot of experience in Africa with some of the rare earth elements, and really China is locking up the market on rare earth elements because a lot of it they're willing to do. They're willing to take the consequences of getting those raw materials that the Western world isn't. With regard to economic impact, environmental impact, so on and so forth.
I think Jan's got a great next question. Legacy OEM purchasing behavior seems to be reverting back to more aggressive tactics with their supply base, both in terms of their behavior and focus on price. What are you seeing?
Yes, Jan. Unfortunately, we're seeing the same thing. We've had a lot of discussions, and we get some laughs when we're with some of the OEM folks. They understand that the profit disparity that we have been seeing is unsustainable. The supply base can't make 1 or 2% while the OEM is making 10%. That's started to level out this quarter, and it's leveling out because the OEMs have been doing some givebacks. But those that haven't gone through to get inflation, those that haven't gone through to fight for price increases are now stuck in a position where the OEMs don't want to give it. The OEMs are losing the golden goose of China and all of the profit that gave them. So they now have to figure out how to make their home markets profitable and more sustainable. And we're going to see more, I'm going to call it bad behavior by the OEMs, where they're fighting with the suppliers and they're doing things differently. Obviously, OEM to OEM, there are different approaches. Some are much more collaborative. There are 2 different German OEMs that we work with. One has a very direct and aggressive, lowest cost always model, and another is much more collaborative with their supplier, trying to get the best quality and the best results out. Both want good quality parts. They always are trying to deliver different things to the customer, though. One is doing a premium product, and one is doing a very a more everyday product for everyone, and that's a challenging situation. So we've got different OEMs behaving in very different ways, and we're hearing from across the supply base that they're seeing a lot of the old behaviors coming back, and it's making it difficult. It's not a helpful set of behaviors, and I'm sure you're seeing it too, Jan. It's not a helpful set of behaviors, and you spent plenty of time in purchasing, and you understand how to work with suppliers. Not everyone in purchasing does, and the young purchasing people that are coming in right now that are just being given instructions to come up with the lowest price, it just doesn't make sense. We see that on some of our bids as well, where we're just brought in on an RFQ, and we're compared to just people that are hired off the street to do the job. Kelly, we were compared in one recent project that we were bidding on to Kelly Temp Services, and people wanted us to price the same way they did. You have to compare apples to apples when you're looking at it, and I encouraged that particular OEM to go to Kelly and use them if they thought that saving on the cost of bringing in the right resources versus the money that they were losing because of quality and line stoppage issues made sense. So everyone views this differently, but purchasing is definitely slipping back to their battle of behaviors. suppliers can look at how do they deal with the OEMs. You can always escalate beyond your buyer, getting to the management level. People that have a bit more experience are acting more rationally across the board in the OEMs, but you have to get beyond the buyer that you're working with. And if you've got a good long-term relationship, most of the OEMs will address that. And you also have to always bring structured data to argue your case. It's very hard to argue with data, and a lot of suppliers don't bring in a good data-driven argument when they go for price increases. So that's what I've seen, and hopefully that's helpful.
Yeah, I would echo that. I mean, it's certainly, Jan, we've seen a pendulum, right? Before the pandemic, the OEMs had the ultimate leverage. It felt like, at least anyway, and that to some degree or the other. During the pandemic and the financial issues that suppliers are continuing to see in most cases, that pendulum swung pretty hard to the other side, and the suppliers started to get significant leverage. And that's starting that pendulum is starting to come back a little bit.
We had that conversation last week, didn't we, together?
We're certainly starting to see that, what you're mentioning. Absolutely.
Thanks for the question, Jan.
Yeah, and this one's related to that commercial topic, but it is a little bit different. And we addressed some of it with looking at the public suppliers, but in your view, what's the current state of supplier financial health, and how is it impacting the supply chain?
We did a lot of talking about that in the last webinar, and a lot of data around that. And the general statement I'd say there is the state of the supply base is not good financially.
Can I use a much more scientific word?
Mm-hmm.
Awful. It is awful.
Right.
We've got inflation. Exactly. So suppliers have these fixed price contracts. So you got the OEM, they only want to pay this, but all of your materials are going up, your labor costs are going up, logistics costs are variable right now. Everything that we've done was built for a low inflationary environment, and we've written contracts for a low inflationary environment, and we're fighting with the OEMs. And I use that word fighting very specifically because there are a lot of fights going on right now with suppliers and OEMs. Those that have come in with good data, with good business cases, are able to get those price increases and improve their financial position. But we're also seeing, we talked a little bit about debt refinancing. Refinancing debt right now is hard, and it's hard because the business fundamentals don't necessarily support the debt at the current interest rates. So if you can't make payments on the debt that you have, your customer is going to have to come step in. They're going to have to help you. They're going to have to raise prices. They're going to have to change the economics so that the banks or the private debt market are willing to work with you. It's a really challenging time to be a supplier. And those of you that are running supplier organizations, I envy you. You're doing a good job. It's really tough.
And I think it's almost counterproductive, the current, quote, awful environment. And so over the longer term, that cooperative approach that Wade, you just mentioned a few moments ago, we've been focused on, it's got to be the right answer over the longer term. I mean, developing a brand new supplier, if you chase one out of town, is not helpful.
Well, we actually love it because the more the OEMs dump suppliers and try to develop a new one, the more work we get. But obviously that's not the right approach.
We should probably keep that to ourselves.
Probably inside thought. So the other thing that we're seeing more M&A, and I think the M&A activity, private equity is coming back into the market. Private debt markets are hot. There's a lot of predatory activity going on right now. So suppliers need to look out for what they're doing, but you can sell your organization. We're going to see more roll-ups. We're going to see a supply base that looks very different in 18 months than it does today. Justin, what's next?
This next one, you may have a view on. How is China positioning itself in the AV market, the autonomous vehicle market, versus the U.S.? Tesla, full self-driving, Waymo, Cruise. And what parts of the AV value chain is China seeing the most success in? And I might throw in something that it does remind me a bit of the software conversation that we were just having about Biden's recent policy, but by the view.
Well, I think China's taking very different approaches to it. I haven't been to China in a bit. We've got some teams over there right now, and I keep getting feedback. I was just in San Francisco for some meetings and had the ability to ride in a Waymo car. And I'll post the video of being driven around by Waymo. It was a very interesting experience. Sitting in the back of a car, that did an absolutely amazing job. There was a car that was in our lane across an intersection at one point in time, so we waited longer than I would have waited as a driver. But the car was all about safety, and it got us there. It got us there quickly. It got us there safely. I didn't feel uneasy at any point in the vehicle. And Waymo's taken very much a hardware-driven approach. Tesla, on the other hand, takes a software-driven approach. The challenge with the hardware approach is if something's not right, you have to roll out and change the hardware across the platform. The software-driven approach is much more interesting because if there's something you need to update, you can tweak the software, you can change it, you can iterate much more quickly.
Flash it on the fly.
You flash it on the fly, and Tesla's continually sending out releases. So they've got two very different approaches to self-driving here in the US. In China, I think we're seeing development of many different models, but you're also going to have the hardware and the software. And with the myriad OEMs, it's really, I don't know exactly who's doing which, but I think it's maturing faster in China. It's also a market where we see a lot of urban traffic, and having urban environments where you can have a self-driving car makes a lot more sense than it does right now in outside on the highways. In a closed loop, where the car knows where it's going, where it's driven it many times, where it knows the potholes in the road, you can map that. As you get larger and larger zones where these autonomous vehicles need to operate, it becomes more challenging. But they're learning.
A simplistic way I think about it, China, in a situation like this, I think of fast follower.
Mm-hmm.
So if they're on hardware now, my guess is we'll see them focusing on software in the future because of this idea of quickly updating, et cetera. I think fast follower is the way I would describe it.
And Apple's the best example of a fast follower. The Sony Walkman was out there.
Yeah.
The iPod came out. The iPod was a nice update to that. They wasn't novel, but it was a better execution.
Yeah.
So I think what we'll see likely is better execution coming out of China, but we won't see those cars or that software in the United States.
This next one, I don't think we've got something in the report on. Jim Cook says, for Mexico, do you have a forecast for the foreign exchange rate? But I think you can definitely comment on the forecast for general labor rate escalation, or just what's your view on labor in Mexico?
If I could, if I understood the Forex market, I'd be a trader, and I'd be a lot wealthier than I am. I think I'd just do that. The Forex market, it's irrational, and there are a lot of inputs that you just can't map out. I actually did an internship at a commodity trading house and watched people lose millions of dollars and make millions of dollars a day on currency trades at the Chicago Mercantile Exchange. It was very, very interesting to watch and to see, but it's not something that I really speculate on. I think fundamentally, the Mexican economy is in decent shape. You've got a labor shortage. You've got infrastructure issues. You're going to have consistent transfer of power. The same party will be there. We're going to see Mexico continue to operate and be the low-cost country for the United States. You've got the tariff exclusions. You've got different things. So I think we'll likely see operating in the same kind of range that we're in right now. We did see a swing when people lost confidence. A lot, in my mind, hedges on the election. If we get a swing to Trump, and if he decides he wants to take on the cartels, that could have a very significant impact. But I don't know whether that's a positive or a negative impact. Will the peso devalue, or will the peso increase in value? And then the labor market in Mexico is it's incredibly tight, and it's going to remain incredibly tight. We're seeing suppliers that we work with in the Monterrey area and the Guadalajara area and the Querétaro area busing people in from more than an hour away. And anytime you get that kind of an environment, it's just hard. People that are getting on a bus to come and work in a plant, there are just days where they can't do it. You have to make sure that if you run an operation in Mexico, you're doing all the normal things. You've got your doctor in the plant, you're feeding people good food, you're taking care of your people as best you can, especially if you're busing them in, because you want them coming to work and you want them happy there.
I was in Guadalajara, as you know, of course, Ambrose, with our team here just a week or so ago, and I was really impressed by the cafeteria and the way that the company is taking care of the folks who are in their plant and on their team. I was very impressed by it, and you could see that dedication to that idea.
And did the management eat in the cafeteria? And did you eat in the cafeteria?
I did. They had set the table for us and everything. It's amazing. Yeah. I probably ate a little too much, actually.
I always try to go down and eat in the cafeteria where
Yeah.
the workers eat, and I eat the food that the workers eat. And they always want to serve you special food.
Yeah.
But if the food's not good, then that's going to be the big problem. So
That wasn't a problem that day.
I think to answer the question very specifically, I don't have a view on what the FX rate is going to be. I wish I did. It's really hard to view it. There are a lot of people that are much better at that, much deeper in things than I am. The labor rates, I expect them to continue to escalate because we don't see the shortage easing anytime soon.
Yeah.
And people will continue at a blue collar level. People will continue to jump for a nickel, a quarter, a dime more. It's very turbulent, and people don't want to be on the bus as long as they are. So if you have someone that you're busing an hour and a half from their home to your plant, and they can get a position that's 30 minutes from their home, they're going to jump, and they may jump for less.
So we're now at our time. I think we'll
Let's
stay
take-
after.
let's take a
and
couple
answer
more
a few
questions.
extra questions. I want to remind everybody that if you registered for this on LinkedIn or if you attended the past webinar, we'll send a copy of this recording to you and a copy of the PDF at some point later this week, incorporating some of the questions we got today. So thank you for joining, and we'll take a few more questions over the hour.
And I'm happy to connect with anyone here, anyone that wants to reach out to myself, to Wade, to John, and have a conversation. Reach out. We're happy to talk about this. If we don't get to your question, feel free to give me a call, send me an email, set up a time to talk. If you'd like us to come in and talk to your management team, we're happy to do that as well, or set up a webinar where we can come in and do a presentation. We're finding that it's very helpful to have these conversations. It's good for us because we always learn by interacting with you, and hopefully you get something out of this interaction with us.
Well, great. Let's take another question.
I keep looking over at the screen that we have that has the questions on it. Sorry.
Right. Same here.
Yeah, so we've got tariffs and software restrictions. This all seems to present an unprecedented opportunity for domestic growth if properly approached in actions. We have the skills, just need to right size and right cost labor with appropriate manufacturing facilities. That's more of a comment, but I think that's something to chime in.
Fully agree. I think that we're basically putting a moat around the castle, and we're trying to buy time. Jim Farley and Elon Musk have made very specific comments about the capability and the skill of the Chinese automakers. We, as Western automotive professionals, have done an amazing job developing the infrastructure in China. The joint venture partners were given tremendous technology. They've got advantages that no one here had when they started, so they were able to leapfrog. And our challenge now is to figure out how do we, in the time that we have, create a better product. We need to innovate. There's something I should post from JD Vance, who talks about you can't just have engineering, you need to have manufacturing. We need to really reinforce that manufacturing sector in the United States, not just in the North American region. And we have labor, we have capabilities. There are regions in the US where we can do it. And we also have to take a very different view from an HR perspective. We have to stop thinking about human resources as risk management and cost containment. And we have to, again, return to focusing on what we did after World War II, which was human capital development. HR needs to be training, HR needs to be developing, HR needs to be growing our team, and not just worrying about DEI and lawsuits and how do we reduce costs and not give people the raises that they're pushing for. So changing the strategy and making it about how do we develop and grow versus how do we contain costs and risk is, I think, going to be important there. And that's one of the limiting factors in my mind to expanding our operations in the United States. We need to have the people, especially the skilled trades, which we're lacking tremendous. Just they're absent everywhere right now. Justin, what else should we talk about?
All
What are
right,
other questions?
I think we've got one from Derek, and he's asking about Ambrose, on your topic of contracts being fixed, how do you see cost downs, such as the traditional 3x3, being impacted? Do you think it'll switch more to a best price model or will these be revisited as time progresses?
I've had the privilege of working with some Indian firms, and part of what I learned is a contract is only a starting point for negotiation. I think with all of the pain, with all of the pressures that have come to bear in terms of inflation, we're seeing more opportunities to have good data and go in and negotiate. In a high inflationary environment, the traditional cost down model just doesn't work. You're not going to be able to outpace inflation with productivity. The model that was built there was very much dependent on your ability to become more productive, your ability to deliver savings in what you're doing, and I think we're beyond that. I would encourage suppliers to negotiate around that moving forward and use the inflationary model. But most purchasing people don't understand inflation. They don't understand that it's likely here to stay. And they grew up or have been trained in a low inflationary environment, or that's the model that they have. So no one's really updated the training. No one's begun to invest in it because it doesn't support the metrics that they have, which is trying to get a lower cost. I don't see OEMs easily giving it up, but I think they're going to have to. Wade, John, do you have a view?
Yeah, I completely agree with what you just said. I mean, the OEMs are going to have to, because of that, I think Jan's question, that pendulum shift that we're starting to see. And OEMs are going to have to rethink the model. The traditional productivity model of just outpacing inflation with productivity and that kind of thing is not something that's sustainable anymore. We're going to have to look at a different model. What that model is, I don't know. Best price model sounds reasonable, but like Ambrose said, just going to be very difficult. Those productivity givebacks were like crack to the OEMs. They're going to have trouble giving that up. So it's going to be a challenge going forward.
And I always come back to the best price model. If we're thinking about that, is that the best total landed cost with quality model, or is that truly the lowest price model?
Right.
The lowest price model, it opens the door for lots of negotiations and lots of change management as you get engineering change requests from the OEM. We almost get into government contracting there, which is a much more aggressive and difficult situation where the OEM needs to make a change. If they're squeezing suppliers for lowest cost, then the suppliers will squeeze aggressively when there is a safety or critical related change that they need that is outside of the specification.
Yeah.
So we don't want this to become a hostile and aggressive market. We need to find a way to build those bridges and develop a better working relationship between the OEMs and suppliers.
Yeah, and sometimes you see this sort of head-to-head or head-butting environment, and the word cooperative is nowhere in the room. And yet, over the longer term, that's what we're describing.
It is, and we have to get back to that,
Yeah.
or we have to get there. Maybe some of the OEMs have been there, and some have never been there. And I think a lot depends on their style.
That's right.
Maybe one more, Justin?
Yeah, I think we can take one more from John Keller, who
Hi, John.
I've actually seen his, he's got a good blog called autodigest.com. I'd shout him out. Do you think that tier one suppliers need to adapt and become less siloed? Seems like the past customer requirements and the model of the supplier business made that so, but maybe that's not the case anymore.
So, John, I started working in automotive a long time ago, and my first client, I was doing program management, had this enterprise-driven architecture that they were trying to roll out across all of their customers, where they were going to have a common architecture for their electronic products. Beautiful idea, wonderful philosophy. They had architects, they were investing in it. Every single OEM wanted to be different. They'd pay a little bit, but not much to be different and outside of the architecture. And it created some real problems and challenges. If we can get to the point where we have more commonality, we're in a good spot, but that takes away the differentiation. And I think right now, any way that the OEMs can differentiate, if we're doing more, I know EVs are harder to sell right now and in less demand. The infrastructure is building, they are selling. And as we move away from internal combustion engines to more EVs or even hybrids, we're going to see a need to have better differentiation. I also think and believe that breaking down silos is absolutely critical. We've got an NPDI offering, new product launch, development launch introduction. When you look at that, if you can bring teams together, if you have people that are on dedicated teams in a design studio, it's counterintuitive, but you almost always save on your development costs. Having people talking, having people working together, having people be a word that John used, collaborative, is absolutely essential. So if we can be collaborative, if we can bring people together, we can do things better. It doesn't just work in automotive, it works in a lot of other industries. A lot of other industries take this approach or mandate this approach. But as we start to see the need to do things better, I would go back to engineering. I would look at from an engineering perspective as you're developing these products. How do we become more collaborative? How do we break down the engineering versus manufacturing silo? How do we bring supply chain into it? How do we get everybody in a room up front? One of the things that I learned to do very early on when we were launching programs was at the very beginning, get everyone together, even the manufacturing plant that the product's going to launch into. Bring them together in the initial design phases once you've won the business, and let's figure out, how do we do this? How do we make this work? So we need to become more collaborative. We need to bring people together. And we'd love to, Wade's based in Dublin. We'd love to come into the Aptiv office in Dublin and present this and have a bigger conversation about it. So I think thanks to everyone for joining. Please reach out if you have more questions. We'd welcome an opportunity to have a one-on-one discussion. Reach out to me on LinkedIn. If you got my number, feel free to call, text, or send an email. We really appreciate everyone joining. We appreciate your time. It's great for us to get your feedback, get your questions, and we hope you've taken something away from our insight in the automotive world.